If you look at the top 10 companies in the S&P, they represent almost 40% of the market cap today. And Nvidia is obviously, the most valuable. They're the biggest. But those same 10 companies only represent about 25% of the earnings. So again, that lets you know that the valuations for those companies are really, really high.
Welcome to Rise Up, where we take a look at this week's top stories and try to translate them to you to continue to help you grow and protect your portfolio. Our mission at Rise Up is to bring you real conversations with real experts and people who directly work with clients every day to help them make decisions through all the volatility that we're seeing. And this week, I think, is a really great week. I'm very excited to be here. My name is Terri Kallsen. I'm a certified financial planner. I'm also a managing partner at Rise Up. My co-host, Joe Duran, is not able to make it today, but we've got two great experts with us today. First off, we have Andy Schwartz, who's a CFP and a CEO of Bleakley Financial. And we have David Mandelbaum, who's also back. He's one of our favorites. He's a former healthcare attorney turned portfolio and wealth manager. Welcome back, Andy and David. All right. Well, one of the things I love about this show is we talk about the big three stories, and we do this each week and what it means in the market. And the big stories this week are Nvidia's $4 trillion milestone, NASDAQ's new record, and what appears to be a belief that the taco trade could be real. As markets barely blinked at the threats of higher targets, we start to see the U.S. biggest trading partners and tariffs aimed at some of the most important sectors, including copper and pharmaceuticals. Andy, could we start with you? Nvidia, it's undisputed now the leader in AI hardware, and they've got this new thing called Blackwell chips. And so, this is record breaking. What should we be thinking about Nvidia and its future?
I mean, Nvidia is a great company. Obviously, if people were lucky enough to own it over the last couple of years, they've done incredibly well. Um, it's the valuation obviously is really high. You hear people. I read a couple of analyst reports where I saw $100 price target on Nvidia, and again, I'm not saying it would. And I saw a 25% upside over the next 12 months. So I think we're all over the world. I think that if you are concerned, or the things to be concerned about, or at least to be careful about, is that a lot of NVIDIA's biggest customers are going to ultimately be their competitors. Now, if it takes a while, NVIDIA could become more valuable. It could be a $5 trillion company. But ultimately, there's going to be a lot of competitors in this space. And a lot of those competitors are actually their biggest customers, which becomes a problem. And when there's a lot of competitors in this space, their margins are crazy high, 70+% margins. That's also, in our minds, unsustainable. But with that said, I wouldn't short it. I wouldn't bet against it. Great company. But I would respect the valuation, which is really, really high.
Yeah, their competitors like Amazon, Microsoft, Google are certainly using a lot of their chips and some of their biggest customers, but that will change over time. And what it also feels to me is that Nvidia's not just a chip company anymore. They're building an entire ecosystem that we'll have to watch over the next several years. David, what is your thought on Nvidia?
Yeah, I mean, as Andy said, great company producing enormous growth. Demand is still highly robust, but Nvidia hitting 4 trillion in market cap speaks to some of the underlying structural issues in the market, which is that the breadth has become very narrow, driven again by, well, now it's not the big seven, it's the big six, but Nvidia leading the way. And I suspect while the company will continue to do great, as Andy noted, the valuation may discount a lot of future growth here. So I think there'll be other areas that will start to catch up and conceivably outperform.
Yeah, I mean, as an investor, if we were to provide any type of context, just remember your risk tolerance. as you think about investing and really making sure that this falls within your portfolio goals overall. And try not to chase the hype if at all possible. You know, many, many tech bubbles, and this could be a bubble, have ended in crashes. And so we have to be able to see both sides and understand both sides. So if you haven't talked to your financial planner about this, I highly encourage you to do that.
Just one other thought, Terry. So another interesting statistic that my CIO Peter Bookvar shared with me this morning. So if you look at the top 10 companies in the S&P, they represent almost 40% of the market cap today. And Nvidia is obviously, the most valuable. They're the biggest. But those same 10 companies only represent about 25% of the earnings. So again, that lets you know that the valuations for those companies are really, really high. So just something else to keep in mind.
Yeah. All taking all that into context and watching every week, I think is valuable. But you did highlight all-time highs. Both the S&P 500 and the NASDAQ composite closed at all-time highs today, obviously. And, we're going to continue to watch that. But David, I do want to ask you a little bit about your feelings on the higher tariffs as a new August 1st deadline comes into play on pharmaceuticals. Really caught my eye that those that are specializing in the healthcare sector was the announcement of potential 200% tariffs on pharmaceuticals. I know you've been bullish on healthcare and certainly pharmaceuticals at times, but do you think this tariff should impact investors' decisions at this time?
Yeah, 200% is an eye-popping number. What was coupled with that announcement, however, was a delay in implementation. Unlike the copper tariffs, which are slated to be go into effect August 1st, as you noted, the pharma tariffs are not going to be not going to take effect for 12 to 18 months as the industry gets its act together, according to the president. So that was actually a relief for the sector because it will give the companies time to both navigate, prepare for, and potentially negotiate with the administration to further delay and mitigate the impact of those tariffs. But certainly, if they went into effect soon at that level, that would be both very challenging for the pharma industry, derivative industries that are levered to the pharma industry, and for patients as well, because it will lead to enormous drug shortages. But again, they're going to be delayed for 12 to 18 months at worst, but conceivably much beyond that.
Yeah, something we'll definitely need to watch as we move forward with access to medicines across the country.
And I would just note one last point about the pharmaceutical sector is that, again, wide disparity among the companies, which ones are innovating well, their growth prospects, which ones are facing enormous patent cliffs with growth slated to deteriorate. But in many cases, these companies now, their stock prices are discounting worst case tariff outcomes, also most favored nation pricing outcomes that are unlikely to manifest in reality.
Hmm. Yeah, that's very helpful, David, as we think about that. But let's move on to our next big story. And this one I think is fascinating. Many are watching and they're saying the democratization of private equity. SoFi and Robinhood both are making big splashes this week, announcing they are making it possible for retail investors to invest in private companies like OpenAI, SpaceX, and others. And this is a really big deal because in the past, only accredited investors or those that are more wealthy who meet certain specifications in terms of their total income and total assets under management. But now, regular people will have access to invest in the next big potential unicorn. Both companies are saying that the investments can be as little as $10. I mean, this is really revolutionary. Andy, what is your reaction to this?
I mean, first, I think it's great. I would caution that whether you're a small investor or whether you're a large investor, clients that we work with that we do private equity or are eligible for private equity, we have access today. that I would just be very cautious. I mean, the private equity space has had tremendous growth over the last 10 to 15 years, partly because interest rates are so much lower, partly because there was so much opportunity. There's so much money now chasing, I think fewer opportunities. And I would just say that just be careful, but I think it's great. I mean, if people are lucky enough to get into the right investments, and there will be some great ones, then they'll have the opportunity to make money like the insiders have done for years. But just because something is called private equity, what private equity means is it is equity, it is stock, obviously in private companies and typically leveraged. And so just everybody just needs to be aware that just because you call it private equity doesn't mean it automatically makes money. I've seen lots of private equity investments basically go down to basically zero. So it's not riskless, but I think it is a very interesting and it's very, very exciting to see this democratization of this, asset class.
Yeah, it is exciting and it certainly could provide that next unicorn. But I just also want to remind our viewers that these stocks or equities are not priced daily like public stocks, so you don't always have access to information. You're really buying this based on what someone else says it's worth. You can't easily sell these shares either. They're not a public equity, and there's asymmetric information. They're not giving you quarterly earnings. They're not giving you all the details, so you can assess your investment decision. So as Andy said, very exciting, but also comes with risk. So talk to your financial advisor about these. David, anything you would like to add?
Yeah, I just to echo what Andy said, great in theory, but the devil can often be in the details. And I will point to this Robinhood announcement regarding, I think it was open AI tokens that, it's unclear what that really is. It's not necessarily a private equity stake, an ownership stake. OpenAI came out and said it's not associated with equity in their company. Um, but it seems like a financial derivative that by definition is going to be highly risky, compounding the risks that you noted, Terry, with regard to asymmetric information and the like. So understand what you're owning, who you're investing with. It's an interesting asset class, but again, the devil can be in the details.
And the only other thing I'd like to say, Terry, is the line or the byline, the democratization of private equity is a great line. As far as I'm concerned, as much as a marketing line as it is an actual real, story. Because I don't want to say that anybody ever has any bad motives when they're doing things, but at the end of the day, these institutions want to find a way to attract more dollars onto their platforms. And so it's definitely buyer beware, for sure. Nobody's doing anybody favors here. So I would just go in eyes wide open and I'd be really, really careful.
Yeah, and this is a great time, I think, to remind our viewers to go to wealthion.com for a free portfolio review. And you have access to people like Andy, people like David, our other experts that we've had, and just do the review and talk to someone about this. Because if you're interested in this space, we want to make sure that it fits into your portfolio so you achieve your lifetime financial goals. I'd like to move on now to our third story, which everyone seems to be talking about, and that Elon Musk's terrible, horrible, no good, very, very bad week. So the CEO he hired to run X recently only spent about a year there. She suddenly resigned without saying why. Tesla stock has dropped 7% after he announced the launch of a new American political party. And he got into a fight on X with financial analyst Dan Ives for telling him to, I think we can say this on daytime video, to shut up. Andy, I think we've heard that before. Andy, as someone whose job it is to manage portfolios and monitor, high profile equities like Tesla, is all this something that you actually worry about, or is it just another dramatic moment with Elon?
I mean, look, for the broad markets, it doesn't really matter. Obviously, if a client called and said, Tesla's cheap, although, you could argue it's not, but it's certainly cheaper than it's been, although it was cheaper 6 months ago. it's a little concerning to me because Elon is look, he's the smartest guy on the planet. He's obviously, the richest person on the planet. And he's brilliant. But a lot of the success, I think, for Tesla, for SpaceX, and the enterprises that he's involved in, a lot of it does somewhat depend on him. And I do worry that the behavior, the distraction, the thought process, it does make me pause a little bit. That if a client wanted to buy it, if he were completely focused, and if I knew that I were investing in a 100% committed and focused Elon Musk, I think, I know Ron Barron, it makes a huge bet, and he's a brilliant investor. And Elon would be a great person to invest in. But I do think he's hurting his brand, but also just the distraction, I think, is a concern. So, it's not a recommendation we would make, because there's just too much going on here that we don't understand or can't predict.
That's right. And David, you've had an interest in investors who like EV space, but maybe worry of Tesla. Are there other companies or sectors you would recommend?
Yeah, it's really hard in the EV space outside of Tesla. Um, Tesla's value has been not just the cars, but the charging infrastructure. They are obviously the behemoth in the space, but the entire market is dependent to a large degree on subsidies, and those are at risk, the EV subsidies. So it's really difficult. And then as the price of oil has dropped, it creates more competition for traditional automobiles against the EVs. China's a major market, but then again, there's lithium and automobile producers there. It's a tough space outside of Tesla, and as Andy noted, Tesla's challenge not just because of some of the industry dynamics, but the CEO himself, who seems to be alienating major segments of his customer base.
Yeah, so maybe the moral of the story is we hope Elon has a better week next week and we can report on that.
Yes.
Um, so let's actually get now to our questions from our viewers. This is the most important part of the show when we hear what's on our viewers' mind. But it's our big topic, and our co-host Joe, who was on last week, brought up this briefly, that it would be good to dive into, our equities overvalued right now? Are we starting to see a bubble? And there are potentially some signs of that, including the S&P's forward PE ratio is now above its historical average. A survey of Bank of America fund managers earlier this year found a record 90% of them believe US stocks may be overvalued. And we've been discussing frequently the market numbers are being driven mostly by the Mag 6 or the Mag 7, but there's a lot of counter arguments that we're continuing to see strong earnings come from US company reports, and economic data is still showing strong growth. So, of course, this has led our viewers to have a lot of questions for us. So, our first question is from Darcy in Olympia, Washington. She first wants to know what is the problem with the stock being overvalued and if she plans on holding on to it for a long time. Andy, do you want to take that one?
Sure. I mean, look, the longer your time horizon, the less important it is what your entry point is, as long as you're buying quality companies. So if you're buying a quality company that's going to be around for decades, even if you're buying it way over, price at the all-time high, that could be 10% or 20% cheaper in the near term, it won't really matter in the long term. So that's not, it's the biggest risk is if you're buying equities for the shorter term. Because in the short term, if stocks are overvalued, they could, they're just much more subject to a short-term reversal. And if your timing is bad and you have to get out, that's when you lose money. Remember, you never really lose money unless you sell the position for less than you paid for it. If the stock goes down and you own it, as long as you hold it and it goes back, to the price you paid or above, you haven't lost any money. And again, if it's quality companies, then long-term, the time horizons typically will be your friend. Look, Warren Buffett was cut in half, I want to say 3 times over his lifetime. And he's the world's greatest investor because he had time on his side. So time is the greatest friend for an investor as long as we buy quality assets.
David, anything you would like to add?
Yeah, I mean, the question is a great question. The the problem with owning anything that's overvalued, buying something that's overvalued, is your margin for error is much lower. So, which increases the risk of that asset, and reduces potentially the return potential. So, understanding the company what you own, the stocks you own, having a view on the growth prospects and how that relates to valuation and risk reward levels is important. To Andy, as Andy stated, though, longer the time horizon, the more margin for error you have. But nonetheless, it can take a long time. And you go back to Microsoft post the .com era, continued to
17
grow,
years.
right, and took 15 years to get back
Yeah.
to where it was. So, and that's because the stock, notwithstanding still excellent fundamentals and growth prospects, was overvalued. So it's important to be careful.
Yeah, so the moral of the story is make sure you know what your time horizon is as you go through this. I want to move on to the next question. This is Paul from Minneapolis, Minnesota. And Paul does believe a lot of US stocks are overvalued. And he's asking, David, I'd love for you to take this one. What sectors may be undervalued right now that would be a good option for him?
Yeah, I'm going to make the pitch again for healthcare, because it is trading at a low single digit percentile valuation basis relative to its 10 and 30-year history, which is an outlier relative to many other sectors, and especially to secular growth areas. Certain cyclicals can be cheaper at times, but for a secular growth industry sector levered to enormous multi-decade demographic and other powerful tailwinds, healthcare is undervalued. Now, again, this is not uniform. The sector is enormously diverse, as I've pointed out before, but there's tons of opportunities, and I suspect as these policy risks, whether it's related to pharma tariffs, most favored nation, some of these Doge cuts to NIH, which are now starting to reverse, as those start to mitigate and are relieved, value and growth begins to accelerate, which we expect for a number of very high quality companies across the space. The sector is positioned to, it looks very attractively positioned to us.
Yeah, absolutely. And the other area that there's at least been some discussion on is the financials. Put the financials and big tech, fintechs may be undervalued. I mean, regional banks are still recovering from the 2023 banking stress. And so they are starting to come around. Rate stabilization helps net interest margins. There's a lot of repositioning in the fintech market. So, there certainly could be some undervalued in the financial space. Anything you want to add, Andy?
Yeah, I mean, energy also could be. The rig counts are almost at an all-time low. So I don't think that there's that much additional marginal supply that can come on to the market. So we think that, there's some opportunities in the energy space as well. I know Peter Bookvar, my CIO, who's a real expert on the commodity side, he likes some of the energy stocks, good dividends and relatively cheap.
Yeah. So let's get to our third question, and that's Marty from Tennessee. He says he's been reading that the global market is where investors can see real value over the next several years, but he's confused as to what global companies or sectors he should be investing in. And Andy, can you point Marty in the right direction of how to navigate both international markets and what companies he should be familiar with?
Yeah, finally, owning something other than the S&P 500 over the last 10 years and even 10 or 12 stocks within the S&P, finally, people are being rewarded, for their non-US exposure. And we really like global value. We like Asia. We've had a very, very good year so far. We've got global value assets up in the 20s, Asia assets in the mid-teens. I would say that I wouldn't suggest that, an average investor try to pick the individual stocks themselves, but there's lots of great, global international funds. We like the value side of that for sure, and you can play that in an ETF. You can certainly buy a broader index, and there's some really great institutions, that do a really good job of picking those stocks for you, which makes more sense to us. Domestic markets much more transparent, much easier, even just to index. We typically don't index the non-US markets. We typically want some managers because it's not as transparent.
Yeah, and I would just add to that, Andy, that, a declining dollar, a weaker dollar historically benefits some of the emerging markets and commodities. So things like Latin America, Africa, Southeast Asia, there just might be an opportunity there. And David, anything you'd like to add?
No, I think that makes sense that we've gotten to the point where where the global markets are presenting more attractive, sustainably attractive opportunities than we've seen in many years, which adds to the toolkit.
And hopefully, if we can get all these tariffs worked out, it'll become even more clear over the next several weeks as we move into August. So thank you. Those are the last of the questions that we have at this time. And now we're going to transition into next week. So our big three stories to watch for next week. And, there's actually more than three, there's four. So earning reports start to come out next week, and we will be hearing from big banks, David, pharmaceutical companies like Johnson and Johnson and Abbott Labs. David, obviously the tariff announcements just happened. Shouldn't affect earnings right now, but do you expect to hear anything new or any concerns from these reports?
No, I mean for certainly some of the non-pharmaceutical tariffs will at least with have impacted buying and demand patterns and supply chain. So for the medical device side of some of these businesses, that will be we will be seeing effects. Um, but Abbott and J&J, both major diversified healthcare companies, so clearly lots of very idiosyncratic items that they will update us on and that we'll be focused on, but also the read through for a number of verticals across healthcare. But will be their reports will be extremely relevant. So big week ahead.
Good. We look forward to hearing about that next week. And then there's additional important data coming next week. CPI,
PPI.
PPI, yep, CPI, PPI, if you can say that 10 times fast. Retail sales and consumer sentiment are also coming out. Andy, the markets, they seem to be somewhat recession and inflation proof, but do you think some of this real-time data will be too?
Yeah, I mean, next week's going to be really interesting. This week's kind of quiet, so not much happening. But remember, even though there's been a little bit of a pause on a lot of these tariffs, we still have the 10% tariffs across the board that are in effect. Plus, you've got steel, lumber, and aluminum. And so I think what will be very interesting to see next week is as companies start to report, are we starting to hear about earnings going forward, and are they being negatively impacted? By the tariffs that are on right now. And then obviously, depending on what happens going forward. And remember too, China, there's significant tariffs on China now, which were in place before. So that's one interesting thing. And then you've got the Fed, what's built in right now, it seems like that everybody's expecting from a pricing standpoint is two Fed cuts between now and the end of the year, probably starting in September. I know that the administration has been, jawboning that they should be cutting rates earlier. And Powell's in a situation where, if he probably, without the tariffs, would be cutting because on the other side, the tariffs being inflationary, the job situation looks like it's weakening. And it does look like there's economic data that shows the economy is starting to weaken. So from that standpoint, it would be a good indicator that they should and probably would cut, but they have to wait to see how the tariffs play out. Next week and the week after, we'll get a better sense of how that's impacting earnings. Because it's not so much about inflation; it'll be a one-time thing. It's more about somebody's got to pay for this, and it is a pretty significant tax. So we'll see what happens.
Yeah. The third story is, this is the first for me. Next week has been declared crypto week by the US House of Representatives, and it will take up the so-called Clarity Act. which establishes a framework for digital assets, and the Genius stablecoin bill passed by the Senate, which would establish a framework for the US stablecoin, which many say could be a game changer for both the US dollar and emerging economies, as we talked about earlier. This is something new. Andy, what are your thoughts on this?
I'm looking. I'm looking at my screens. I mean, Bitcoin ripped today. So at an all-time high. It's a bit of a as much as because I'm not smart to understand it. So I would say that it's as much as anything, it's a supply and demand trade. If the public and if the markets and investors want the assets, then the assets will go up in value. If fewer people don't want the assets, or fewer people want the assets are going to come down in value. People like to talk about these assets like digital gold. We don't really buy that because we think it's different. It's more of a risk on asset. With that said, though, I mean, our clients own some. We don't tell people not to own it, but a 2 to 3%, position almost as a hedge, could be prudent as long as you have a long-term outlook. But again, I think it's too early to tell, but it is a very, very interesting space to watch. And certainly the last couple of weeks have been really interesting. I mean, this is, it's really gone up a lot in a very short period of time.
Yeah, so, Rick Edelman did come out and say 10 to 40%. I think that presents a perfect opportunity to talk to your financial planner, your wealth manager about that. Understand your portfolio, do a portfolio review on wealthion.com, and have the conversation. What is best for you? When Rick Edelman comes out and says that, he's giving a very wide range. And what we want to make sure for you as an individual investor, you get the right portfolio for your goals and your time horizon. Lastly, the last big story next week is finance ministers from the group of G20, which represents 85% of the global economy, are meeting in South Africa. And tariffs are certainly to be the top topic. So, David, any thoughts on that?
Well, maybe we'll see some nice deals announced in conjunction with those meetings, but I would expect that um, most, if not all, of the participating companies will try to lower the temperature, so that could be positive. I wouldn't expect that it would lead to more concern around tariffs, but we only have what, 3 weeks before these deals have to be struck. So that's what we'll be looking for out of that meeting.
Well, thank you guys. I'm excited for next week, and we'll be here again next week. I just want to thank all of you for viewing. I want to thank all our viewers for their questions, for subscribing, and for interacting so that we can get you the most helpful information as you make important financial planning decisions. So, David and Andy, once again, you have such a high level of expertise, but you're able to translate it for our viewers so that it can be actionable for them. So, thank you again for joining us.
Always great to be with you, Terry.
My pleasure, Terry.
Thank you. Have a great day.